Did you know that the way you own a property in the UK can significantly change the amount of tax you pay? In this video, we'll break down the real tax implications of owning property in the UK and how to legally reduce your tax burden. There are four main taxes on UK property. In this video, we'll walk through each one, when it applies, how much you pay, and what you can do about it. First up is Stamp Duty Land Tax, or SDLT. This tax is triggered when you buy a property, or really anytime the ownership changes hands. The amount you pay is graded, meaning it increases as the property value goes up. Next, we have Capital Gains Tax, or CGT. This is a tax on the profit you make when you sell or dispose of a property. There's a small exemption for non-residents, and the tax rate varies from 18% to 24% depending on your other UK taxable income. If you're renting out your property, you'll need to consider income tax. This is paid annually on the rental income you receive. If the property is owned by a company, then corporation tax is paid instead, and the rates and rules differ slightly. Inheritance tax, or IHT, is levied on the value of a property when the owner dies. However, if the property is owned by a company, IHT may not apply. Instead, the annual tax on envelope dwellings, or ATED, might be relevant. ATED is an annual tax and it is tiered based on the property's value. Here's a quick look at the ATED charges for the 2025-2026 tax year. As you can see, the higher the property value, the greater the annual charge. Now, let's talk about reducing these taxes. SDLT is difficult to avoid when a property is sold. However, in some cases, owning the property within a company structure might offer a way to negate the tax, as technically you're selling the company, not the property itself. But remember, this may mean ATAD becomes applicable. Similar to SDLT, using a company structure might also be a strategy for managing capital gains tax. Instead of paying CGT on the property sale, you'd be liable for corporation tax when selling the company shares. Again, keep in mind the ATAD implications. When it comes to income tax on rental income, holding the property within a company can sometimes lead to a lower tax threshold. However, it's crucial to consider your other income sources, as this will influence the overall tax liability. Let's illustrate that with some examples. As you can see here, depending on the rental income, using a corporate structure can result in a significant difference in tax paid. Inheritance tax for non-residents generally applies to UK-based assets, including property. There are a couple of ways to mitigate this. Firstly, you can transfer the property to a UK spouse, though this might only delay the IHT liability. Secondly, gifting the property through a trust is possible, but this is complex and requires careful planning. Currently, there's a nil rate band of $325,000, meaning no IHT is paid on the portion of the estate below that. Other strategies include taking out life insurance to cover the potential tax bill or using an interest-only mortgage to reduce the property's net value for IHT purposes. However, HMRC may scrutinize refinancing. Again, owning the property through a company might remove the IHT liability, but remember, ATAD comes into play. It's a trade-off, and you need to calculate whether the annual ATAD is more or less advantageous than a potential future IHT bill. Be cautious, as HMRC may investigate company structures that appear to be set up solely to avoid taxes. A final but crucial point. UK tax advisors are very cautious about promoting aggressive tax avoidance schemes. They prioritize compliant and tested solutions. It's vital to seek professional advice to ensure you're operating within the law. Please remember that this video provides general information only and is not financial advice. Always consult with a qualified tax advisor for personalized guidance based on your specific circumstances.